9 ways to build wealth like a CFO. Most people manage money emotionally, but CFOs use data, strategy, and discipline. In this video, we're gonna talk about how you can apply that mindset to your personal finances, so let's get into it. The first way to manage money like a CFO is to build a personal cash flow statement. You can't expect to make any changes to your finances or adjust them for the better unless you accurately can track and recognize what you're spending your money on today. And so at the end of every month, literally pull your credit card statement and copy and paste over every single transaction that you've done for the past month and categorize each one of them by a need or a want. Your needs are rent, grocery, insurance, stuff that you literally cannot function without, and wants are what you decided that you wanted to spend your money on, whether that's going out to eat or going out with your friends, buying a new video game. And being able to track where your money is actually going is gonna be the first step to making a difference. I like to operate under the 50-30-20 rule, which means that 50% of your take-home pay goes towards paying your needs, 30% of it goes towards wants, and 20% of it goes towards savings. But before you can get there, make sure that you track what you're spending on and have an idea of what percentage of your income is going to wants or needs versus savings so that you can think about making those adjustments going forward. The second way to manage your money like a CFO is to monitor your liquidity like it's mission critical. Liquidity is the ability for you to get cash quickly. And so cash sitting in a bank account is liquid. Cash sitting in a brokerage account or a stock investment that you can quickly trade is liquid. Having your money tied up in a house or a car payment is illiquid. It's an asset that you have, but you're not going to be able to get that cash quickly in the event that you need it. You need to monitor what your liquidity is and make sure that you have at least a 6-month emergency fund built up in case, heaven forbid, there's an emergency, you'll be able to get that cash quickly. I think it's something like 40 or 50% of Americans that make $100,000 are 1 or 2 paychecks away from going broke. And so you don't want to be there. You want to make sure that you have enough liquidity to take care of yourself, and is one of the most important metrics to keep an eye on so that you can appropriately manage your personal finances. Before you make any big purchases or investments, make sure that that emergency fund is fully replenished. And then once you have that basis set, you can think about what to spend that money on going forward. Once you have your personal cash flow statement and have that emergency fund replenished, the next way to run your finances like a CFO is to forecast out what your finances would be 6 to 12 months out. And make sure to use realistic assumptions over here. Under the 50-30-20 rule, where you're saving 20% of your finances, what I always recommend that you do is that you automate that saving so that you're paying yourself first. So that instead of saving whatever it is that you have left over, the first thing that you're doing on auto payment from your checking account to savings is moving 20% of your take-home pay over to savings. And if you're projecting out on a month-by-month basis, you'll put in an input for what your monthly take-home pay is, and then whatever the savings rate is that works for you. I say 20%. If you need to do 10 or 15%, you'll be able to measure out month over month exactly what that amount would look like. For that savings, once you have your emergency fund built out, you should be investing your money in low-cost ETFs that are diversified across, and we're not chasing the big investment returns. We're looking for a safe, sustainable 5 to 7% year-over-year returns. And so what you can do is calculate out with each of those dollars that you're putting in what a 7% return would look like so that you can estimate over the course of a year what your liquidity is going to look like. If you know that you're going to have any big expenses coming up, then you need to make sure that you're appropriately budgeting that, and by building out a 12-month cash flow forecast for yourself, then you'll be able to accurately prepare yourself for that without setting yourself behind. If you build out a 6 to 12-month forecast, what you actually end up doing is building yourself a 12-month financial plan. And the next thing that you want to do is to be able to track KPIs or key performance indicators like your savings rate or your net worth, just like a CFO would. There are a couple of ways to be able to track what your net worth looks like. What I personally do is I have an account through Betterment where I have my high yield savings account. And through that, I connect my credit cards, checking account, and brokerage investment accounts, 401k, everything pools together and Betterment can track what my net worth is. And under the spreadsheet that I use for my 12-month forecast, within that, I update it actually to see what my net worth is at the end of every month, just so that I can monitor what it is. There's really two key metrics I think about when it comes to building net worth. Number one is what the actual market is going to return. I say that you should measure out 5 to 7% as far as a forecast goes, because that's generally what the S&P 500 returns, but you won't have any control over what the market does. What you do have control over is your net flows or your savings rate. And so if you can tie your savings rate to a percentage of your annual income, like 20%, that's the lever that you're gonna be able to control in order to grow your net worth over time. And so when you're forecasting out what you think your net worth is gonna be, you wanna be able to track what the market is actually returning for you year over year, which is something that you can't control but will contribute to your overall net worth. But more importantly, you want to be able to track what the actual total dollars are that you're saving, because you can control that. And if you can't do the 20%, by actually tracking those key performance indicators and measuring it over time, you'll be able to think about a plan to move that savings rate from maybe a starting point of 5 or 10%, and maybe over every month or every few months you can increase it by 1%. And that's the way that you'll be able to control what goes into growing your net worth over a long period of time. Tip number 5 to grow your wealth like a CFO is to conduct quarterly financial reviews, where you are the only board member that you need to present to. But if you're actually doing the work of documenting and forecasting what your financials are going to look like over a period of time, then it's good to take a step back and actually review that data every quarter. Realistically, every month you're going to be busy and probably not able to track and think about what adjustments you can make, but every quarter you should set some certain time aside so that you can do that review. You want to track what it is that you've been spending your money on and where you can make adjustments so that you can save more money or move more money into investments. It's important to track what your cash flow, debt, and investments look like over a period of time so that you can pull the right levers and make adjustments so that you can really work towards that long-term financial plan. If you set time aside every quarter and to actually do that review, then you're going to be able to make adjustments and steer the ship in the direction that you want to go to, because it's all about making slight changes to the ship and letting time do its thing so that you can automate your savings and investments and build your net worth automatically so that you can focus your time and energy on other things besides just your finances. The next tip to manage your money like a CFO is to start seeing everything as an investment to create long-term value. Investments compound over time, and the more money that you can put to work in investments in the financial market that generate 5 to 7% returns per year, the more those returns are going to generate even more year over year. And so if you start to think of your dollars as a way to work for yourself and every purchase that you make to be an investment, then you're gonna realize that if you're spending money on a multi-$1,000 vacation, that money will be out the door and gone. Let's say you spend $10,000 on a vacation. That's $10,000 that's gone. If you instead took that $10,000 and skipped the vacation, put it into an investment, the next year that would return close to $1,000 for you, and then the year after that, another $1,000, etc., etc. By reframing your money as something that needs to work for you, you'll think twice about spending money that you don't have to when you can invest it into another project that would ultimately make you more money. It's hard to save enough money for a house, and so if that's something that you want to do, then you need to make consistently right decisions over a long period of time. And the way to do that is to start thinking of your money as an opportunity to make money for you, and recognize that over a long enough period of time, all those small decisions that you make together will compound together and get you to where it is that you want to go, but you need to put in the work. It's simple, but not easy. You have to put in the work to do it. CFOs are always conscious of what their company's debt looks like, and you should too. So the next tip is to optimize your debt structure. There's a difference between good debt and bad debt. Good debt is what you take on to make an investment in yourself, like into your education or a house. Bad debt is when you take on high interest debt that you didn't need to get yourself into in the first place, and now you're beholden to an interest rate that you can't afford. You want to make sure that you're managing your good debt, like your house payment, your car payment, and your student loans, and avoid bad debt like the plague. Less debt is better than more debt. But we all can't afford a $300,000, $400,000, $500,000 house. And so you need some debt to help you be able to get that goal so that you can ultimately become financially free. You need to pay down your bad debt ASAP. And the most critical example of this is credit card debt. If you have any credit card debt, once you have your emergency fund built up, you need to focus on paying that down as soon as possible, because thinking that you're gonna be able to invest money and use those investment returns to pay down your debt is a losing strategy. And so try to pay down that debt that's highest interest for you first and work your way down, and then realize when you have good debt and how you can manage it accordingly so that you can keep reinvesting into yourself and keep having your money work for you. Tip number 8 is to invest based on risk-adjusted returns. When it comes to instruments to make money, the least risky investment is to have cash. Then bonds are the next least risky, and stocks are the most risky. Because of that, stocks generally return the highest yield because it's the least guaranteed. When you put your money into stocks, there's an opportunity that it can drop down to zero. If you hold your money in cash in a bank, that value is gonna stay as is in the bank account. When it comes to managing your personal finances, there's no one size fits all answer for everybody because the psychology of money impacts everybody differently. I recommend that you have 6 months worth of savings in a high yield savings account for an emergency fund, but some people will feel more comfortable with 12 in case something happens, and some people will feel more comfortable with 3 so that they can chase more yields in investments. When you are investing your dollars in stocks though, my recommendation is to focus on index funds, which is an opportunity to invest in hundreds of companies at once so that if one of them goes south, then you don't end up losing all of your money. Sometimes people want to invest their money into a stock like Tesla, and then they need to ride out the 50% drawdowns when something happens. And if you really need to get money for an emergency or a life event like a wedding that you want to plan, then riding that volatility wave is not going to be the best for you. And so I recommend when you're diversifying your investments and your leftover savings, then you do what's comfortable for you as far as having a fund available in case of an emergency, and the extra money goes into a set of diversified ETFs so that you're protected in case anything goes south, and then you'll be able to still generate returns over a long period of time. When it comes to managing your finances, it's helpful to think of yourself as a business where you can systemize and automate the process so that you can focus on reinvesting into yourself for growth, and most importantly, doing it sustainably. Wealth isn't built by chance, it's built by design. If you start thinking like a CFO, then your money will start growing like a business. So if this helps shift your mindset, make sure to like the video and subscribe to the channel because we have more videos like this coming.